The housing bust just started as sellers slash prices. I'm your host, Steven Van Metre, and thanks for joining me today. And sellers are telling their realtors to get me out now as they believe prices has peaked and the bubble's about to pop. Let's head over to CNBC where we picked today's story up as home listings suddenly jump as sellers worry they may miss out on the red-hot housing market. Sharply higher mortgage rates have caused a sudden pullback in home sales, and now sellers are rushing to get in before the red-hot market cools off dramatically. The supply of homes for sale jumped 9% last week compared with the same period a year ago, according to Realtor.com. That is the biggest annual gain the company has recorded since it began tracking the metric in 2017. And this just adds to this whole supply and demand story. We've seen it with the retailers where supply is rising rapidly as demand cools off. And many said this would not happen to the housing market, but now it is. Real estate brokerage Redfin also reported that new listings rose nearly twice as fast in the 4 weeks ending May 15 as they did during the same period a year ago. As rising mortgage rates has caused the housing market to shift, and now home sellers are in a hurry to find a buyer before demand weakens even further. And we used to get 10 to 15 offers on most houses, according to a real estate broker in the Los Angeles area. Now I'm seeing between 2 and 6 offers on a house, on a good house. And this is true. Anybody who's sold in the last couple of years knows all you have to do is just put a listing out and you'll get a flood of offers. And for that number to drop down to a minimum of 2, maybe as much as 6, that's a dramatic downturn, telling us that buyers are now starting to get in control, and that's going to send prices even lower. While home sellers were in the driver's seat barely 6 months ago, they are now seeing far less competition from buyers. A demand index from Redfin, which measures requests for home tours and other home buying services, was down 8% year over year during the week ending May 15. This was the largest decline since April 2020, when the pandemic paused most home buying activity. And here we go, another headline right out of CNBC as home sellers are now lowering their price at the fastest clip since 2019. And nearly 1 in 5 home sellers dropped their price during the 4-week period ending May 22nd, the highest rate since 2019, according to the weekly Redfin study. Now, you have to think about this. Nobody has predicted that prices would go lower. No expert, they've not said, hey, that we see this market cooling off. In fact, they've told everyone that prices are going to continue to go higher and you need to get in now. And now what we're seeing is due to the drop in demand, prices are starting to come down as buyers disappear. The catalyst? Well, we'll get to that soon enough. The same 4-week period saw 13% fewer home for sales browser searches on Google and a 12% year-over-year drop in home tours and other related services from Redfin agents, the largest such decline since April 2020. And meanwhile, the market composite index, which tracks mortgage purchase applications, something we look at every week, dropped 1.2% during the week ending May 20, and sales of new homes at their lowest level since April 2020, down 16.6% from March. And taken together, numbers suggest that increasing homeownership costs have shrunk the pool of potential home buyers, forcing sellers to lower their prices. The interest rate on a 30-year fixed mortgage has surged by 2% since January, increasing monthly mortgage costs by 42% year over year as of May 22nd. And that's really what this story is. Everyone said, the market can handle higher prices. Buyers will have no trouble doing this. We're at a boom. Everything's going to be good. Everything's going to get better. And what's happening is prices are rising faster than wages. And when that happens, buyers have no choice. They go to the gas pump and the prices are rising faster than their wages. They go to the grocery store. They go to the real estate market. Everywhere they look, prices are rising faster than they can afford it. And there has to be some give somewhere. And we're seeing that in reduced consumption. And this is exactly what you see what happens when the Fed not only starts to pull back on the reins of monetary policy, but we have a simultaneous effect of fiscal stimulus now being gone. And those two together, well, that means prices are coming down and demand is going with it. Now let's look at some of the catalysts here is all these articles talked about the 30-year fixed mortgage rate. And I wanted to point out that mortgage rates now are higher than they were back in about 2019 and near the highest level since this last economic expansion started. And, you think about what's going on here is people wanted out of bonds. They dumped their bonds in droves, and one of the highest numbers of sellers since the 1930s. people wanted higher interest rates. They believed everyone could afford it. And now what they're finding out is people can't afford it. And as you know, what does that mean for bonds? Well, that means interest rates are coming down and bond prices are going up, because when you see these backups in yields, what happens? And we've talked about this on the show a number of times. They lead to new all-time low in yields. And why is that? Well, yields have to fall far enough where people will demand credit again and they will want to borrow. And where did most of the borrowing happen at this cycle? Well, it happened near the lows, and that's why you will see rates eventually come crashing back down. If we look at home buying conditions here from the University of Michigan Sentiment Survey, now there's 3 lines here. There's a blue, which is in houses, and red, which is vehicles, and gold, which is durable goods. But look at the blue line. It's down here in the 1980s to 1984. This was a period I, as a child, saw homes sit on the market for over a year, and no one would come look at them. Or if someone did, there was no offer, no buyers. And now look, demand for housing in terms of sentiment is collapsing at those levels, suggesting that, as we talked about, buyers are tapped out. This isn't a market they can afford, and they are going to drive where prices are going, and sellers are going to have to be forced to lower them. Sooner the better. And what other catalysts do we see? Look at the new one family houses sold in the United States. This is a fantastic data series by the Federal Reserve, St. Louis Federal Reserve Branch. And notice that you see one family home sales rising, and then they collapse, coming into recession, collapse, coming into recession, collapse. And now look, you see in the pandemic, because of low rates and all that fiscal stimulus, what happened? Demand for homes surged, and people wanted out of the city. Get me out of here, put me out in the country. And now all of a sudden, the inevitable collapse is actually starting. And what is the catalyst? Can you imagine? Check this out. We've got the Wilshire 5000, which is a total U.S. stock market on a year-over-year rate of change. And notably, when the wealth effect goes away, well, what happens is home sales start to come down. You see, here's some good examples going back into the late 80s, early 90s. The stock market starts to come down. The real estate market sales go down. Look here, the market comes down, and you see home sold go down. Market starts to stagnate and fall, and home sales come down. And you see it right here again. The market is a leading indicator of this wealth effect. And you think about where people get their down payment from. Maybe it's not them, maybe it's from their parents. You think about how they're posting collateral to show the lender that they can afford the house. Well, if their net worth is going down, well, so is their ability to buy a home. But these signs were pretty obvious. And of course, when we start looking at other data, we can see it. But there's one thing that shouldn't be going down when the housing market blows up, and that's your portfolio. Be sure to check out Portfolio Shield. I'll put a link up here in the corner and in the description below. Let's continue on, because we knew this was eventually coming as U.S. pending home sales dropped for a 6th straight month, and the worst skid since 2018, as contract signings decreased 3.9% in April from a month earlier. Pending contracts are telling us they'd better reflect the timelier impact of higher mortgage rates than closings. Home prices in the meantime appear in no danger of meaningful decline. Well, we'll see about that. Now, pending contract is simple. Let's say I put my house up for sale and you put an offer on it, and you sign it and I sign it. That is a pending contract. Doesn't mean that you can't back out or I can't back out. It just means we now have a pending contract. And those are a great leading indicator of where the market is going. And how about previously owned home sales? Now, these are completed contracts. They fall to the lowest since June 2020, as existing home sales dropped a 3rd month in April. And when sales drop, well, prices are soon to follow, as contract closings decreased 2.4% in April from the prior month to an annualized 5.6 million units, figures from the NAR. The median forecast in Bloomberg survey economists called for 5.64 million. So once again, experts missing the mark, as higher home prices and sharply higher mortgage rates have reduced buyer activity. It looks like more declines are imminent in the upcoming months and will likely return to the pre-pandemic home sales activity after the remarkable surge over the past 2 years. And that is rosy optimism right there, because that implies that buyers are just slightly priced out of this market. In reality, they're completely getting priced out of this market. Cash sales represented 26% of all transactions in April, down slightly from the prior month, but still elevated. Investors who typically buy up in cash and are therefore less sensitive to mortgage rates made up 17% of the market. So again, we're seeing still a lot of speculation in the market. And of course, we know what happened in the great financial crisis when too much speculation ran rampant. People said prices couldn't fall. Well, they did, and a lot. But how about new home sales? We see in April the biggest monthly drop since 2013 as sales fell 16.6% last month as mortgage rates make ownership more expensive for buyers. And this is the same story over and over as new home sales, which make up more than 10% of U.S. home sales, something nobody said was going to stop, are tracked when contracts are signed, while existing home sales are tracked when contracts are closed. That makes new home sales a leading indicator of where the market is headed. And all these indicators are telling us that it's time to get out now because the best of the housing market is likely behind us. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.